Well, hello, Providence Financial friends and family. I'm Anthony Sicaro, founder and president of Providence Financial and Insurance Services, located in Woodland Hills, California, just west of Los Angeles. And periodically, I like to do market updates. I like to share with you things that I think you need to know with regards to what's going on in the economic environment and how it affects us helping you. And if my voice sounds a little scratchy, I apologize. Just getting over a sore throat that I've had pretty viciously for the last week. But I wanted to get this information out to you and didn't want you to wait. Jerome Powell, who is the federal Fed head of the federal chairperson of the Federal Reserve Bank, spoke the other day in his confirmation hearing, and he said some things that really caught my attention. And one of the things that he talked about was inflation. And the other thing that he talked about is how they're going to combat inflation. And those two things really affect income portfolios. You know that we have you invested for income. You know that your portfolio is going to fluctuate up and down, but the income is going to remain relatively constant. That's how we have you invested. So if you're spending your income and your portfolio goes up, it doesn't help you. If you're spending your income and your portfolio goes down, it doesn't hurt you. So you're spending your income. You get to keep spending your income. Now, if you are not spending your income, if you are reinvesting your income and the portfolio goes down, the asset price goes down, well, that's actually good news because you then get to reinvest at a lower price, because we're going to be reinvesting the dividends and interest that you're not spending. And of course, you would rather buy at a lower price than a higher price. So if you're reinvesting your portfolio and the asset price comes down a little bit and we reinvest your money, that's good news because you come out smelling like a rose when the price comes back. And we have you invested for income. Now, income investments are affected primarily by interest rates. Not so much by the stock market. If we have a panic sell like we did back at the beginning of COVID, everything's affected, and so we're income producing investments. But the short-term effects on income producing investments tends to be interest rates. And if you've watched some of my videos or listened to my podcast, you know that when interest rates go up, income investments tend to come down a little bit. And Jerome Powell said yesterday that he expects 3 to 4 interest rate increases over the course of this next year. So not great news for income portfolios. So I wouldn't be surprised if we see the income portfolios go down a little bit. Your income is going to remain consistent, but your portfolio may actually come down a little bit. Now, we haven't seen that yet. It's only been 2 days. We're not going to know until the month end. So I'm kind of just putting this out there as my thoughts. But it's also, if you're reinvesting, it's also not bad. If you're getting your income, it's also not bad. It doesn't affect you either way. So I wanted to get that out with regard specifically to the fact that there are probably going to be several interest rate hikes this year. Now, what could change that? Well, if the stock market starts to go haywire, that could change that. If inflation goes down, that could change that. And I'll talk about inflation here in a minute. But the stock market and its reaction could change that. If the market crashes, the reality is that they're not going to raise rates. You don't ever raise rates in a crashing stock market. But if the market crashes, inflation will probably be immediately tamed as well, and they won't have to raise rates. And that's always a risk. You have to remember that if you have money in the stock market, there's always a risk that the market could crash. No one in 2007 thought that the market would be 60% lower in 2009. No one in the year 2000 thought the market would be 50% lower in 2002. That's always a risk, and no one can predict when or where or how much it's going to happen. We know that there's going to be some crashes in the future. We just don't know to what extent they're going to happen. It's almost like earthquakes in California. We know they're going to happen. We just don't know where and how far and who's going to be affected. Same thing with wildfires. We don't know who it's going to be affected. We just know they're going to happen. Well, the stock market doesn't go up. We know that at some point there's got to be some corrections, and we just hope that there's not another crash. But the reality is it could happen. What's different, though, this time than back in '08 and back in 2001 is that the Federal Reserve basically has decided to just print money from 2008 and on. And they've pretty much told us through their actions that they're not going to let another major crash happen. Certainly, they don't want a major crash. And really, if you throw a bunch of money when the stock market is crashing, it's going to stop the crash. And that's what the Federal Reserve did back in the beginning of COVID, March and April of 2020. Market went down 37% in 37 days, and the government printed trillions of dollars, and it pulled us out of that crash. Well, that's fairly new for what the Federal Reserve is doing. They didn't do that in 2001. In 2001, when the market was crashing, the Federal Reserve lowered the interest rate, and that stopped the crash, or the crash just ran its normal cycle. They didn't do that. They didn't print a lot of money in past decades. 1987, when we had a crash, they didn't print any money back then. They let it run its normal course. But we have a crash in 2008, and they started printing money at the bottom of the market once they had lowered interest rates, and that didn't work anymore. They started printing money, and then the market came back. And it's still arguable whether or not the market came back because the Fed was printing money or whether the cycle was just done. And there's arguments on both sides of the coin. But the reality is the Federal Reserve started printing money, and they printed money all the way, I think it was through 2014. Then they stopped. And then when COVID happened, they started printing money again. So this is a tool that they hadn't used before in any kind of extreme degree like they've had. And from 2008 to now, the market, or rather the debt of this country has tripled. We're almost $30 trillion in debt. We were like $8 trillion back in 2008. So we've more than tripled. We've almost quadrupled, better said, our debt load over from 2008 till now, which is what, 13 short years. So the stock market almost believes that it doesn't need the fundamentals anymore as long as it has the Federal Reserve. And the reality is that if the Federal Reserve is going to continue throwing money at it, then it is likely going to cause any crash or correction that we have to be short-lived. You realize that the COVID crash 2020 the crash and recovery occurred within 10 months. That type of crash and recovery normally takes 6 to 8 or 9 years. It occurred in 10 months because the Federal Reserve threw money at it. So the reality is, are we ever going to have another significant crash and recovery that's going to take us 6 to 9 years? Or is it always going to be much shorter lived? Well, we don't know. We don't have any history of this because the Federal's only been printing money for the last 13 years. So we don't know, we can't say. But I do think that if we do have another correction this year, and I think we could, that it will probably be shallow, maybe 10 or 15%, and probably be short-lived. Now, I've changed my projections based on changes in what I've heard, changes in research that I've studied, and all the things that I kind of do behind the scenes to stay sharp and in tune with things. So it was 2 months ago that I thought maybe we could have a correction as high as 25%. I think I might have put that out on a video. I certainly did a couple live TV interviews with that. But I don't think 25% is really on the table anymore. I think closer to 10 or 15% as the normal course of a correction. But a lot of people are thinking we're not going to have a correction at all in 2020. The last 2 years have done 20% plus, 25% last year, and I believe, I just don't have the numbers in front of me, but I think 2020 was up as well too by 20% if I remember right. So we've had 2 great years despite a pandemic that's now gone 2 years when everybody thought it was going to be over 1 year. And it almost seems like there's nothing stopping the stock market. I don't think that we're going to have another year like the last 2. I don't think we're going to see another 20 or 25% year. But there's a lot of people out there predicting, 8 or 10%. And I think that's very possible that could happen. I also think that we could have another 10 or 15% crash. I did a live TV interview this morning, and that's exactly what I said. I think it could be a 10 or 15% correction, but I think it will be short-lived. I think it will come back quickly. And if that happens, I think it will be a buying opportunity. So a little bit of market analysis from my end as far as your portfolios. Now let's switch subjects for a second. Let's talk a little bit about inflation. A part of what Federal Chairperson Jerome Powell said yesterday is that the Fed's got it wrong with regards to inflation. They thought inflation was going to be transitory, and now they think inflation is going to be a little longer term. And that was interesting. I'm still not 100% convinced that it's going to be terribly long term, but there is that question out there, whether it's going to be long term or whether it's going to be transitory. And the answer is probably both. Or what do I mean by both? Well, inflation right now is somewhere in the 6% range, and it's been between 5 and 7% now for the last 6 months or thereabouts. And that means things have gone up quick. You've seen it at the fuel pump. You've seen it at the grocery store. You know, in the years past, inflation has kind of been this ambiguous number. Like we just kind of bought it. They tell us inflation is 2%. Okay, that's nice. We didn't see it in the grocery store. We didn't see it at the gas pump. Now we're seeing it. It's real. I've talked to people every day, people that call in from our radio show, or even you guys. I talk to people every day that say, we feel it. My wife just recently, over the holidays, bought a prime rib, and I don't remember that number. It was expensive, a lot more than I thought it should be. But the bottom line, she said, I bought the same prime rib last year, and it cost the same amount of money, except this year it's half the size. And that's inflation. So inflation's real. It's hitting us in our pocketbooks at this time. And that's something that we were hoping could be short term, but looks like it might be a little longer term. But so the inflation is here. Now, if inflation turns out to be transitory, which to me means a couple years or less, if inflation is 6% for 2 years, well, that means everything's gone up 12%. And then inflation backs down to 2%, like some people are saying it will. If that happens, well, then the inflation will have been transitory, but it's not going to give back the 12% that we have, that everything's gone up by. So that 12% is probably going to be permanent. And then the rate of inflation going forward might decrease back down to some more of a normal level, 2, 3, or 4%, but it probably is not going to take away the 12% that it already gained. And that's why I say both. It could be transitory, it could be long-term inflation as well. I think it's important to understand that. But now Federal Chairperson Powell is concerned that it could be longer term. And if it's longer term, then it's going to start to get into the psychology of corporations and the psychology of business owners and people, where they're going to start doing things to try to offset for longer term inflation. And that may not be good for the stock market. It may be good for the stock market. Inflation generally is good for the stock market, but there's arguments on both sides of the coin. Now, I put out a video, I think 4 or 5 months ago or so, where I talked about this, and we thought that inflation might be transitory. That's kind of my thought. I still am not convinced it's going to be longer term. I still think it could be a year. I think for sure it's going to be through 2022 and maybe into 2023. I just don't know if I see 6% beyond 2023. I don't know. I'm not predicting either way. But the reality is, in the video that I did a couple months ago, I had said if we think inflation is going to be a little longer term, we might have to make some adjustments. And that's kind of where we are now. With inflation predicted to be longer term, not as transitory as everybody was hoping, there are some things that I think we need to adjust in your portfolios. The reality is that prior to the COVID crash, our target for your portfolios was to get in the range of 4.5% to 5% of income. 4.5% to 5% of income. Well, for the 10 years prior to COVID, inflation was 2%. So we were very well ahead of inflation at that point, even at 4.5% or 5%. So we didn't really have to worry about it. You were getting your income, your money was secure, your investments were safe, very conservative, and it worked. COVID now, with inflation at 6%, getting 4.5%, 5% is not keeping pace with inflation. Now, some of you have sizable enough portfolios where it doesn't matter. It's really not that big of a deal. You never have to worry about running out of money. You keep getting your income. As long as you're not dipping into your principal, your income is enough to cover inflation and, whether we try to make some moves or not. But a lot of you are not in that situation. A lot of you need to keep pace with inflation. Just to make sure that you don't lose your buying power if you live another 20 or 30 or more years. So there's been a couple of things that we, Sound Income Strategies, and I have done over the past couple of months, even prior to COVID. You remember we put out a video just because interest rates were going down, and we talked about some things that we have done to try to offset the lower interest rate environment. Well, the good news is those same things that we have done are also going to help offset a higher interest rate environment as well too. So it will help offset the lower yields that we're getting because the 10-year treasury went down, but it will definitely help to offset inflation as well. And those two primary things that we've done to offset inflation and lower interest rates is we've added REITs to the portfolio. REITs are real estate investment trusts, and we've added dividend paying stock to the portfolio. And I've done videos on both of those, REITs, dividend paying stock. I've talked about Eric Byrich, who is the Chief Investment Officer of Sound Income Strategies. He's the chief stock picker. He's a value stock picker. He's beaten the S&P 500 multiple times over his 30-year career. He's done it with companies that are solid and companies that tend to pay dividends. And so I've talked before about all the research that he does, weeks worth of research before ever putting a stock on the approved list. And what he's looking for are stocks that are going to pay higher dividends and stocks that he thinks are not going to suspend the dividend, stocks he thinks that could weather any storm that could come, and also stocks that he thinks could even raise the dividends. And stocks are a good inflation hedge. When you look at things like gold or you look at other things, stocks are by far the best inflation hedge out there. Gold is not. Gold for the last, I want to say 71 years or 75 years has averaged like 4% return. Stocks have averaged double that, and dividend stocks have averaged triple that. So dividend stocks are a good inflation hedge, but they're a little more risk. But you still get your income in the form of a dividend. So the dividend paying stock gives you your income. So if the market goes down and Barry has chosen, not Barry, sorry, different guy, Eric has chosen some good stocks, then you're still going to get your dividend along the way. And if the stock market does go down and we reinvest your dividends, that actually works in your favor because you're not having to sell shares and we get to buy more shares with the dividends we're reinvesting. And again, if you're spending your dividends and you're not having to sell shares, then short-term fluctuation in the market doesn't mean anything to you because you're still going to get your income. So by having dividend-paying stocks, what you're really doing is taking any market fluctuation out of the picture. So if the market does go down 10 or 15 or 25 or 30%, long as you're living on your income or reinvest your income, doesn't hurt you at all. And yet, over the long run, it's shown to be a good inflation hedge. So that's one thing that we've done to try to combat inflation and lower interest rates is added more to a lot of your portfolios in the form of dividend-paying stock. Now, this is not something we do without your permission. I've put these videos out before, and a lot of you have called me and said, hey, we want to get more money into dividend-paying stock. We want to do that. And, how much do we think? And I've had calls with you, and we've increased your stock market exposure because of the request or the videos that I've done in the past where you will call in and ask me. And I'm going to do the same thing again. I do think more than even before, because of inflation and the reasons we talked about, that you probably, I'm going to say most of you probably should be increasing your stock portfolio to some degree. I'm not talking huge amounts. I'm talking, for those of you that have no stock portfolio, maybe 10, 20%. For some of you that already have 20 or 30%, maybe you don't increase it at all. But at this point, I'm thinking probably no more than maybe 40, 50%. And some of you are thinking like, you might be cringing, like, I don't know about that. Good. That's okay. This is not mandatory. It's something that I think is worth having a conversation, and every one of you is different, and I have individual conversations with every one of you. So if you think you want to increase your stock to holdings to some degree to focus on dividends and potential growth to try to combat the short-term inflation, I'm going to welcome you to call me. Call me at the office. Or better yet, email me or email one of my staff members. Jacqueline, you can always email her. Crystal, you can always email her and just let them know you want to talk with me about maybe increasing your stock portfolio. And I'm more than happy to have a one-on-one conversation with you. So that's the first thing that I want to mention. And then REITs, real estate investment trusts. Real estate has generally been a good inflation hedge over time. The reason is because the stock or the share price for each REIT tends to represent the value of the underlying real estate. So as real estate grows, so should the share price. And at the same time, real estate companies invest in real estate for the rents that they get. And by investing for the rent, sorry, my screen turned off for some reason, so I had to go lock me out, put in a new password. I couldn't see myself. I didn't know if my recording was continuous. So let me continue. Sorry about that. Bottom line is that because real estate investment trusts invest in real estate, they're investing for the rent. And most rents have escalator clauses, which means every year the real estate or the rent is going to go up a little bit because of inflation. So the fact is that they're good inflation adjusters on both fronts, because the rents go up every year, which means dividends we would like to see go up every year. And also because the cost of the shares, the price of the shares could go up as real estate goes up as well too. Now, it's a space that you want to be really careful in. So the reality is our experts behind the scenes at Sound Income Strategies have chosen 10 REITs that they think make sense, REITs that they don't think will suspend the dividends, REITs that they think could weather another storm if we have another variant breakout. And so if someone wants to put REITs in their portfolio, we're not going to put more than 10% in their portfolio. Just because there's still some risk in that space. So let's do this. I am at the point where I am very encouraged with what we see with the market. Even if we do have a correction this year in 2022, I think it'll be short-lived. I think it'll be a buying opportunity. If you want to add some money to the market based on what we've talked about, just a small percentage, we're not talking about a lot. We're not talking about taking on a whole bunch of risk that you're not taking on now, but maybe adding 10 or 20 or 30% of your portfolio to the market, then call me. If you want to add REITs to your portfolio and you haven't done that already, then call me or email Jacqueline or Crystal. Would love to have that one-on-one conversation with you. And we'll talk about it individually and see if upgrading or adding a little more risk to your account to offset inflation makes sense for you. I hope this has helped. I look forward to hearing from you. If I don't hear from you, then I'll just assume that we're going to leave everything well enough alone until you and I speak again. God bless. Have a great week.